Good morning and welcome to the REFUELS N.V. investor presentation and Q&A. Throughout this recorded meeting, investors will be in listen-only mode. Questions are encouraged. You can be submitted any time using the Q&A tab just on the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Philip Fjeld, CEO. Good morning, sir.
Thank you, and good morning to everyone who's tuned in or who are taking the time to catch up on this on demand. So we're going to run through today an updated company presentation that we put out into the market a couple of weeks ago. Just first, introduce who we are and provide a couple of key investment highlights. As of today, we've got 15 stations, 13 operational, 2 in build. You might wonder what a typical station looks like. We've got a slide on that a bit later on. If we then look at the typical run rate, EBITDA generation from our station network, and we look at expected annualized run rate towards the end of this year, we should be at around 12 million, or we expect to be at around 12 million pounds. If you look on year-on-year growth, looking at the last quarter, we're close to 50% annualized growth. We're expecting to be in that ballpark, there or thereabouts. Clearly hard to predict exactly how quarters will range depending on when trucks are delivered and so on and so forth. But that's where we're expecting to be going forward. We helped our customers reduce their greenhouse gas emissions by over 150,000 tons in calendar year 2023, and that will of course be considerably larger this year. So that's something that we're very proud of. We announced some weeks back that we've launched a transaction where we are looking to rationalize our structure and bring back in stations that today are financed and sit outside of our corporate structure in a company called CNG Foresight, which is a joint venture with Foresight, a very large green infra funder here in the UK. We have a transaction ongoing. Can't say too much about that for now, but that is an ongoing process which we are looking to update the market on later. Once again, looking at some numbers, we've got 13 stations operational today, 2 in build, as you'll see later on during the presentation. We have an ambition to build or to put into build a considerable amount of stations later this year. If you look at our customer base, you've got north of 1,700 trucks exclusively using our network today. Our customers have confirmed orders of close to 1,000 trucks that should be delivered in the next 12 months. And in addition, from our customer base, we know that they've got plans to continue to order a lot more trucks in 2025-26. You might wonder, why aren't those confirmed orders? Purely because no truck operators, logistics operators, typically order trucks before maybe 9 months before they need them. So if you need a truck by mid-25, you're not going to order that before later in 24, and you're certainly not going to order trucks for 2026 before you're well into 2025. If we then look at what does a typical truck consume and how does that translate into gross profit, etc. A typical average vehicle that goes through our network uses about 32,000 kilograms or 32 tons of biomethane a year. That results in there or thereabouts 6,000 pounds of gross profit. If you look at station economics, 2 to 4 million. Typical EBITDA from a steady state. Baden's got a bit of a couple of slides on that later on, and that provides a strong return for the invested capital. If we start on the left-hand side here, you see we've got rapid growth here in number of vehicles on the road. I think the best way to illustrate it outside of just that graph is also to highlight that it took us 9 years. We founded the company 10 years ago. It took us 9 years to get to 1,000 trucks there or thereabouts using our network. It will take us 15 to 18 months beyond that sort of 1,000 truck date to get to 2,000, which is a good illustration of how we are now seeing true mass adoption. If you go to the right of this slide, we sort of just illustrate again our annualized EBITDA run rate at the station level, which today is north of 7 million, and we expect, based on the order book of vehicles, to be in the range of 12 million by the end of this year. Taking a look at the market, so what is the size of the market that we typically, are looking to address? Well, there are 230,000 so-called heavy goods vehicles in the UK that are 18 tons and above. However, the typical rigid market, which is your large box truck market between 18 to 26 tons, has 85,000 vehicles in it. That is not really our core market. That said, we are seeing significant growth in that market from our customer base. But the way we look at it, our core market is typically the articulated truck market, the tractor and trailer combination, which makes up about 100, or there are 145,000 of those vehicles registered in the UK today. If you then look at how many trucks have we got on the road in that market share, today we've got north of 1,500 trucks in the articulated market. So as such, we are just above 1% market penetration in total. Of course, with a confirmed order book, that will increase going forward. If you look at our customer base, just got some examples on the right here. There's a much longer list than that, of course. But now we are really starting to see true mass adoption occur, not just amongst some of our long-standing customers, but also among a much broader base. And that's important because that means that we have a more, I'd say, robust portfolio of customers when it comes to growth going forward. Getting a bit technical here, but I think this is an important slide to understand. In the UK, we've got two types of articulated trucks. You've got a 4x2, which is one rear axle, which can typically operate up to a total combination weight of 38 tons. And we have a 6x2 truck, which has two rear axles and can typically operate up to 44 tons. Now, 6 tons difference might not sound much, but of course, when you're doing hundreds and hundreds of extra runs or runs per year, and you multiply that by 6 tons for every run, it soon adds up. The majority of the UK market is by far the 6x2 market. We, however, have very, very little market penetration, as you can see from this slide, pretty much negligible market penetration. 4x2 market, however, we do have strong market penetration, very strong market growth. We expect to be north of 10% of that market by the end of this year. So why haven't we got the same growth happening in the 6x2 market? Because the vehicles haven't been available. The truck manufacturers haven't prioritized building 6x2 CNG trucks. That's changing. Second half of this year, you can get factory built CNG trucks in the 6x2 space, and we're expecting that market to really start to take off from the second half of this year onwards. So what's in it for our customers? A typical gas truck or typical CNG truck does cost more to buy than a diesel truck. So let's say 20 to 25,000 pounds, depends on the specification, depends who you are, what kind of framework agreements you've got with the manufacturers, and so on and so forth. However, the fuel is cheaper, considerably cheaper. So your typical average vehicle saves about 15,000 pounds a year on fuel, which then means that you have a strong payback and fairly short payback on that 20 to 25k. So we're typically seeing payback within 1 to 2 years on that additional capex. Typical average fleet keeps a vehicle for 5 years. So not only do they get to run on 100% renewable and sustainable fuel through biomethane that we supply, but they also get to save money compared to running a diesel vehicle. And that's important because there's a lot of our customers tell us they can't afford to lose money, to go green and lose money. Yes, they can maybe do a certain percentage of their fleet with more expensive solutions, as I'll put that down as R&D. But if you're going to see true mass adoption, you need a solution, a fuel and a vehicle solution that can provide and that stacks up against diesel, and ideally is of course better than diesel. Just providing a bit of an overview so that you understand what one of our stations look like. If you think of a typical petrol diesel forecourt where, whether it's a BP or a Shell garage or Esso or whoever it is, that's not what we do. So please sort of cleanse your mind of that one. This is our station in Newton Aycliffe, northeast of England. This is a 2-acre plot, so 8,000 square meters. We need a fair big chunk of land in order to build our stations. They are grid connected, so we are pipeline connected. So we need a good capacity pipeline nearby. We need a good capacity electrical transmission nearby, and we need to tick a lot of other boxes, which I'll mention a bit later on. But this typical station, which is one that we is more or less a blueprint that we're trying to roll out where we can, subject to the size and the layout of the land that we've got. This station can refuel 14 trucks simultaneously. Typically costs £6 to £7 million to build, depending on whether we lease the land or buy the land. Between 600 to 1,400 refueling events per day, and more importantly, they're unmanned. Because they're unmanned, the drivers do all the work, as such the refueling work. Our running cost of these stations, yes, they're not cheap to build, don't get me wrong, but once we've got them built, they are very, very efficient. We remotely monitor them. We've got a team of engineers that come to site, if something, if alarms occur and so on and so forth. But at the end of the day, we need very few trucks to go through here on day one, once we open it, in order to support cash flow break even. If you look at volume growth, we founded the company in 2014. This graph only shows from 2016. Prior to 2016, we're so far down, you probably wouldn't even be able to see the data point. But it took us from 2014 to probably second half 2020, early 21, so between 6 to 7 years, to really build an offering, to build an industry, to get buy-in from enough customers that this is indeed a reliable solution. They can replace diesel trucks with CNG trucks, and they can run them just as they do, and their operation can be run just like they have been doing for 30 years with diesel trucks. So it's important then to understand that we really started to see liftoff from 21 onwards, and of course going forward now, our growth is not constrained by the amount of customers that are interested in adopting CNG trucks. It's purely down to 6x2 trucks, clearly very important, they're coming, but it's also down to us continuing to roll out our station network, which is why getting the transaction done where we are bringing in-house again the stations under the Foresight joint venture is important to us, so that we have everything under one umbrella going forward. Just some figures on our network. When you look at the 15 stations, 13 operational, 2 in build, but when you look at the total capacity of those 15 stations, we can refuel north of 10,000 trucks a day. Currently, north of 1,700. So we've got a lot of additional capacity, hotel rooms if you want, that we could fill going forward. Because as you see, we're at currently less than 20% overall steady state, but once again got strong growth ahead, given the confirmed order book. If you look at the right-hand side here, and what we're trying to show here, what we are showing here, is that for every new station that we're now building, it takes very few months for that station to become cash flow positive. On average, between 1 to 3 months, typically, for a station to become cash flow positive. And that, I think, is a testament to, yes, they're expensive to build. There's a lot of capex that gets deployed. But once you've built them, you need actually very few trucks to go through there in order for those stations to become cash flow generative, and as such start to pay back the investment. If you look at our total addressable market, and the market that we've, and by the way, these aren't our figures. These are figures that are one of the leading consultancies in the UK have come up with. But if you look at the total market, and you'd say that could be, for CNG trucks, could be between 50 to 90,000 trucks. Today, we've got just north of 1,700 that are going through our network. We know that our customers have placed orders for close to 1,000. So that takes us up to 2,700 plus. In addition, as I previously mentioned, we have customers who've told us and expressed their plans for ordering for 2025 and 26. And in addition, we've gone out to a broader subset of customers and said, well, what are your overall plans for not just 25, 26, but also further out? And then we've ended up with in the range of another 5,000. So as I say, there is a lot to come going forward. And for every station that we put on the map, for every station we open, we sometimes get a question, but isn't that just going to cannibalize, trucks and demand from other stations? No, that's not what it shows. It actually shows that encourages our customers to all continue to order more trucks and to mass adopt sooner, if you want. Why? Because they, if you've got 1,500 trucks in total, diesel trucks, and given where our station locations are today, you can maybe only deploy 100 CNG trucks. It doesn't really move the needle. But once we then tell them we've got plans to build here and there and there, once those open, all of a sudden they can, deploy 300 or 500 or 600 trucks. All of a sudden that becomes meaningful. So it is the network effect here that's important, and for us to continue to build stations is a very important reason for why we're doing this fundraise. Building stations takes a lot of time, unfortunately. Not actually building them, but securing land, negotiating with landowners. Got a slide on that a bit later. So we've developed something called an MRS, mobile refueling station, which is a skid-mounted or basically trailer-mounted station, mobile station that we can put on a customer's depot or on a site where we are building a station, but it isn't operational as of yet, so that we then pull forward truck orders. Today, we've got 7 of these in operation. We've got another 2, one in build at the moment or an order, another one that we expect to be an order in build later this year, and further plans to build more next year. Each one can refuel up to 100 trucks a day. I think our busiest one is just north of that, 105, 110. And today we've got north of 500 trucks that go through these MRSs. These MRSs then get moved on to other locations as we open grid-connected stations. So as an example, we've got Aylesford, our Kent station is in build, will open very soon. We have an MRS there now, which is being used to satisfy demand in the area. As soon as that station goes live, the MRS gets removed and gets put onto another site during the summer. And with that, I will hand it over to Baden.
Thank you very much, Philip. So our stations can comfortably handle between 450 and 750 trucks per day. Now, it does assume between 1 and 2 fills per day, as our trucks generally are in a back to base and return to us to be double shifted. And then, of course, it depends on the pressure tier of the station, depending whether we've built on medium, intermediate, or high pressure stations, which then dictates the maximum flow rates and the number of vehicles we can get through in a 24-hour period. We like to use the concept of steady state, not full capacity, because some of our stations have enormous capacity, around 30 million litres of diesel equivalent per year. So capacity is really a sort of comparative figure. We consider steady state a comfortable level at our stations to be about 65% of dispenser capacity or 85% of compressor capacity within a 24-hour period. Whichever one is lower, we consider that to be the steady state of the station, and that enables us to have ample room for the peak flow periods when lots of vehicles come through on similar operating cycles. We charge our customers a compression margin, which is currently just over 25 pence per kilo. It's identical for all customers. We don't differentiate between fleets depending on their size, to keep everything very fair and transparent. And that's increased upwards with inflation every quarter. The portfolio currently generates around 13.5 pence or so per kilo of EBITDA, per kilo of CNG that we sell, just from the compression margin alone. And that is based across not just our existing portfolio of mature stations, but also some of the newer stations that haven't seen material economies of scale so far. But just to demonstrate the margin improvement over the last year, average EBITDA margins over the last year or so have increased about 60%, which shows the benefits of scale through new electricity contracts and operational activities. Ongoing EBITDA margin contribution from our stations is between £2 to £4 million per annum once they're at steady state, based on the current compression margins, and that depends. That obviously depends largely on their capacity and the grid connection pressure. Based on current adoption rates, we see payback periods on our new stations between 4 to 5 years, Again, just on the compression margin, not on the any RTFC revenues, which I'll run you through in a minute. Okay, so as Philip's mentioned, we currently operate 13 stations, grid-connected stations. We have a further 2 in development, one which is very soon to be opened, and 14 of which have been funded by the CNG Foresight joint venture, which we are currently exploring opportunities investment opportunities for. A near-term plan to take another 5 highly attractive sites into build in 2024. That'll increase truck capacity across our network to more than 13,000 truck capacity per day, which is around 10% of our entire total addressable market in the articulated vehicles of both the 4x2 and the 6x2 fleet, which is coming. Given the depth of our pipeline, with more than 100 CNG stations currently in the pipeline, we're now able to high grade the next stations we build. A luxury which has taken many years to get towards, and that means that we can maximize the rate of adoption at new stations. So the next 5 stations will be in build fairly quickly, in fairly quick succession after each other. Cost around between 30 and 40 million pounds and have a payback period of less than 5 years with IRRs. It's 16-year IRRs unlevered in the range of 25 to 45%. So very compelling IRRs. So you can see here the difference between a 4x2 and a 6x2 vehicle and the importance of the transition from the 4x2 to the 6x2 fleet over time, not just for the customers, but also for the revenues at our stations. You can see on the right-hand side the graph that our volumes are very consistent on a sort of per truck basis. For instance, over the last year, they hovered roughly around the same level. But as our customers begin to add more 6x2s to their fleet, that number will increase. That average utilization per truck will increase because the 6x2s are a heavy, slightly less fuel-efficient vehicle, and therefore the average number of kilos per annum that we expect from the vehicles will remain the same. Gross margins per truck have increased from about 12 pence per kilo earlier in the year to around 17 pence per kilo now. And that's due to a couple of factors. One is we've now become a large electricity consumer. So we've moved to a new set of tariff rates, which have created a very large drop in the cost of goods sold. We've also seen a rebalancing of the electricity markets following the energy crisis of 2022. And we've got also improvements in the logistics as we've continued to add to that mobile refueling station fleet. We've improved those logistics, and that's also brought down our direct costs sort of on a per kilo basis. What you can see, and to put into context the earnings of the stations of the fleet as it grows, we anticipate a vehicle's life of about 1 million kilos, 1 million kilos over its at least useful first life. And that based on the gross profit per truck should bring in between 44 and 56,000 pounds per year, per truck over its lifetime of running through our stations. If you want to put that into context of the 960 trucks we currently have on order to arrive, over the next 12 months or so, that is a contribution just from those vehicles, not on the road yet, of 50 million pounds of gross profit over the next 5 years. So here you can see the current portfolio's run rate is just over 7 million pounds at the end of March 24, on an annualized basis, and that's from running our existing 13 CNG stations. The same that over the next year, towards the end of the year, will increase to a 12 million pound run rate, and that still remains at relatively low utilization levels across the portfolio, even though we'll have added 2 more open sites by then. So currently just about 20% of our steady state levels, and we'll be around just over 20% by the end of the year, because of course we'll have added well over 1,000 trucks worth of additional capacity. So based on the confirmed order book alone, we'll be around 12 million pounds of EBITDA per annum on a run rate. Steady state level, which once again is not a full capacity, that is our version of steady state. At our station portfolio at our existing station portfolio that is open of 13 stations, 8,800 trucks capacity, would be 44 million kilos of EBITDA contribution per annum. And of course, we've mentioned before our medium-term target of 30 to 40 stations by the end of 2026. That is 30 to 40 stations open and or in development by then. That will take our capacity across the network to more than 25% of the UK's entire articulated fleet and be a truly nationwide network. So you'll have heard us probably talk about RTFCs before, but just to introduce these again, our customers want to run on the highest possible amount of biomethane they can to maximize the amount of emission savings they have. And we, of course, want to be able to provide them with as much biomethane as is feasible at any time. We also generate RTFCs, renewable transport fuel certificates, from dispensing biomethane into vehicles. And when the market is behaving normally, we can generate very large amounts of extra value to the business on top of the compression charge, which we charge to customers. So we generate 3.8 RTFCs for every kilogram of biomethane that we dispense into vehicles. This is in addition, as once again, to the charge which we charge customers, because they do not pay an additional charge for biomethane. So the RTFCs pay for biomethane. We do not have a contractual obligation with our customers to beyond the reasonable endeavors obligation to supply them with biomethane, because of course it depends on the market value of these somewhat, albeit yet we are incentivized, and as are they, to supply as much as possible. Historically, margins on RTFCs have been in the 30% range. However, they've been depressed over the last 18 months or so due to the alleged fraudulent import of large quantities of biodiesel from Asia, which is being investigated by the EU Commission. That is now starting to wash through. We are seeing markets normalize. We are seeing prices recover, and we anticipate that will continue over the year ahead to bring the market back into balance and to enable us to purchase a lot more biomethane for our customers. But what does the RTFCs do for our EBITDA contribution? So what I've shown here is towards the end of our year, once we have our 950 or 960 trucks are delivered, we anticipate a £12 million EBITDA contribution from the compression charges alone at the CNG station. You can see around the current levels of RTFC price around 19 pence. The RTFC contribution is around 1 to 2 million. It's not really very material. However, by just increasing the RTFC value by about 3 pence, to 22 pence, you can see that we effectively double the combined EBITDA RTFC contribution to the business, and once again another 3 pence will increase that further to triple what we would make from the compression charge alone. At steady state, you can see in the table below that further increases as we move towards a £44 million contribution from the compression charge alone. But obviously, very large amounts of additional revenue can be generated at very low RTFC prices. The RTFC buyout is 50 pence and is historically traded between 25 and 35 when the market has been normal. So it is not outside the realm of possibility that we will start to drift back into the normal range over the months or year ahead. Thank you.
Thanks, Baden. So just starting to wrap up then. We have 13 stations operational today. We've got 2 more in build. So if you look at the in build and planned construction, we've got a 7 number there. 2 of those are in build today, Aylesford and Doncaster. And then we've got 5 more stations that we'd like to put into build during calendar year 2024. More importantly, though, on the right-hand side here, you see late stage development or under contract, early stage development, etc. We often get the question, okay, why aren't you guys building more stations? Why do you continue to say it's so hard to develop these stations? We must stress that actually building them, once we're ready to put a digger on site and actually build it, typically takes 8 months. That's not the hard part of what we do. The hard part of what we do is all the work that comes before. Finding a plot of land, we need a plot of land that has good road access, that gives us good probability of getting planning approval, that has good connection to a large capacity gas pipeline, electricity network, and so on and so forth. Then we need to negotiate with the landowner. It can take between 2 months to 2 years. Then we sign a option to purchase, option to lease with the landowner. Then we can do our surveys. It can take 6 to 12 months. Then we submit a planning application. It takes 12 months to get approval. Then we might have 6 months to discharge certain conditions, and then we can start to build. So, having a dedicated land team that we have, 5 people that only do one thing, which is secure sites, and make sure that we've got a well-stocked pipeline of sites coming through, is important. And it's probably actually also one of our biggest competitive advantages, which we'll get into in a bit. But as I say, we've got 2 in build. We want to put another 5 into build later this year. And then from 25 onwards, we really want to start cranking up the construction process. Here we are, excuse me, just moving on slightly. I just want to highlight a couple of slides from the appendix, and then we'll go into to Q&As here. Talked a bit about our competitive advantage and why what we do might, on the face of it, if you remember the image of our Newton Aycliffe station, you might say, well, hang on, that's a lot of concrete. It's got, looks like some compressors that you've installed there and some dispensers. I mean, that can't be that hard. Well, to some extent it isn't. Anyone can go out and buy a compressor or compressors. Anyone can get a civils contractor to pour some concrete and so on and so forth. And dispensers, once again, you can go to a number of manufacturers in Europe and get them. That's not really where the complexity comes in. The complexity comes in around the locations, as I've just mentioned, which can take many years. I mean, we have got one site that we want to start building later this year that we have been negotiating for 8 years. We're still not building. I know that's an extreme example, but we have lots of sites that we will start building in the next 12 months that have taken us 3 to 4 years to mature. We have in-housed a lot of our competencies. We do all our design, we do all our commissioning, we do all of our building, apart from driving diggers and pouring concrete, etc. But all of the critical elements of what we do that in-house. If you look at the customer base we've got north of 150. I think that's slightly outdated now. I think we're probably north of 160 customers now. During the last quarter, once again, it's taken a long time to build that, but that has really gotten us to a big lead going forward. And now we're really starting to see the benefits of the network effect. It's given us economies of scale and huge operational leverage in the future. Yes, we've got in total within the group, when you also include the biomethane sourcing, we've got north of 90 employees, but we only need to increase my headcount probably 20%, and we can comfortably serve basically 3x the amount of stations we've got today. So we've got large operational leverage that we are just starting to see the benefits of, but which we will see a lot of benefits to going forward. And with that, I will just move back to the appendix. And probably, or not probably, with that, I'd like to say thank you for the presentation, and we'll go into the Q&A section.
Fantastic. Philip, Baden, thank you very much indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions just using that Q&A tab situated on the right-hand corner of your screen. Just while the team take a few moments to review those questions submitted today, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we had a number of pre-submitted questions and questions submitted during today's presentation. Thank you to all the investors for submitting those. May I just ask you just to click on the Q&A tab there, guys, and just where appropriate to do so, read out the question and give your response, and I'll pick up from you at the end.
Thank you. Yeah, I've got a bunch of questions. We'll try and be fairly speedy to go through here so we don't keep you guys for too long. Please, can you provide an update on your progress with the £150 million fundraising? I briefly mentioned that, but I'll probably highlight it again. That's an ongoing process. We announced it 3 weeks ago, I think it is now. That is an ongoing process. We will provide an update to the market when it is, when we have something meaningful to say. Clearly, it's market sensitive information, so I wouldn't be standing here giving any indications. It is an ongoing process. We're spending a lot of time working on that, and we'll come back to and update the market over the coming weeks or month on that. When do you expect the RTFC market to recover? Excellent question. And our crystal ball is probably as good as anyone else's. Baden touched upon it briefly. The RTFC market has been, I'd say, severely depressed over the last 15-ish months. Why? The European biodiesel market was swamped with Asian volume. Allegedly, some of that was fraudulent, and there is ongoing investigations. What we're starting to see, however, is the market is starting to rebalance. This huge wave of biodiesel that came into the market is starting to wash through, and there seems to be a more healthy supply-demand balance in the European biodiesel market. Now, you might say, well, why is biodiesel important? Because biodiesel and the price spread between 1 litre of biodiesel and 1 litre of fossil diesel is what determines typically the RTFC value, because the majority of RTFCs are generated through biodiesel blending, and therefore that's what's the marginal fuel, and as such sets the price. As I say, the market is showing indications of rebalancing. Just in the last couple of weeks, CEO of BP, ENI, and some of the large energy players in Europe have come out and said they are seeing the market rebalance, and they are expecting margins in the market to improve from second half onwards. They are clearly better informed than we are, given that we don't produce or blend or trade biodiesel. And as such, I think that's a good indication, or at least from our perspective, this is something that will continue to improve as we go forward. Please, can you explain why there has been such little uptake in the 6x2 market to date, given its larger share of HEVs? Yeah, great question. Sometimes we get the question, which is, well, is CNG, is that really only a fuel that is suitable for 4x2 vehicles? I mean, by far the larger market is the 6x2. Does that mean that CNG isn't a good fuel for that market? No, it's an equally good fuel, but we have been held back by the truck manufacturers who, for various reasons, haven't prioritized to build a CNG 6x2. And then you might say, well, why is that? Well, first of all, a 6x2 truck is I'm not going to say it's only sold in the UK, but the UK is by far the largest 6x2 market in Europe. But then again, the UK market is not huge compared to the rest of the European market. So therefore, the truck manufacturers, of course, have to cater for the number of markets. And as such, the UK market isn't necessarily one they'll prioritize early on to get the correct vehicles designed and built. However, that's in the past. 6x2s are now coming. And as I say, there are factory produced 6x2s that will start to roll off the production line from second half onwards this year. We wouldn't expect to see a lot of them in 2024, but 2025, we're really excited by the 6x2 impact, or the impact that we believe the 6x2 is going to have on our future growth going forward. Are you seeing competition from heavy-duty electric trucks? Once again, good question, and I'll probably provide a bit of additional context around that. We have the benefit of, because we are basically 100% of the public access CNG truck refueling market in the UK when it comes to stations, we have the benefit of working very closely with the majority of the large fleet operators in the UK. And we have very honest, frank, transparent discussions with them. We are not aware of a single one of those operators who has current plans to mass adopt electric trucks or battery electric trucks in the heavy end of the truck spectrum. Heavy end means the articulated truck spectrum. Now, why is that? Well, it's for the following reasons. The truck is more expensive, considerably more expensive than a CNG or diesel truck. It might only have an operational range of, let's say, 300 kilometers. They typically need 600 to 800 kilometers to match what they can do with diesel and CNG today. They have a payload loss because the battery weight and so on and so forth. So they can carry less goods, which of course impacts the economics. And finally, charging is an issue. There's a lot of focus on vehicles. People say, well, here you are. Here's a spec of a large electric truck which can do X, Y, and Z. Sure, that's not really the main constraint. One of the big constraints is charging, and I'll give an example. So there's a lot of talk about mega chargers, because that is what the industry will need if the articulated battery electric trucks are really going to take off. A mega charger needs, hence the name, a 1 megawatt capacity connection to the electricity grid. In many places in the UK today, you can't get that. Or if you can get 1 meg or 2 megs, but you certainly can't get 10 or 15, which you need to charge an entire fleet. We would like to build a station in Swindon. For those of you who are English, you'll know a bit about Swindon. For those who don't, Swindon is a fairly large place, lots of people there, lots of industry, car manufacturing plants there, lots of trucks in the area. we have been told, and we need a 1 meg connection for our station, that we can get that connection in 2037. Now, that would be the same for anyone who wants to run battery electric trucks. So we are not negative towards battery electric trucks, absolutely not. We will be, over time, providing fast charging opportunities at our stations, but we will be led by the market. And as of today, market demand is for bio-CNG and for CNG trucks. We're not seeing any material demand for the long-range articulated trucks. Okay, what strategic benefits do you see from acquiring the balance of the station portfolio and the financial return impact? So, couple of answers to that one. Do the financial return impact. First of all, by doing so, we can consolidate the stations. Today, they're sitting outside of our finances as such. We're not consolidating those earnings. We get the benefit from those earnings. As you've seen in some of Baden's slides, we have a rapidly growing EBITDA contribution, which basically translates into cash contribution. By bringing those in-house, we ring fence those earnings, and we can use those earnings to catalyze our growth going forward. Also, in the strategic side of things, clearly an in-house structure, a simpler structure where we have everything under one umbrella, is something that we see as beneficial. But the main impact for us here, I mean, those stations are branded CNG Fuels, they're run by CNG Fuels, they're our customers, and so on and so forth. The main impact for us here is really to bring them in-house, to get the benefit from those rapidly growing cash flows going forward, so that we can use those to basically, as a catalyst, but also turbocharge our financing and growth going forward. Where are you seeing competitors? Is this from the major fuel players? Okay, so I've probably addressed the fast charging, because sometimes we get question, if we're going to look at the competitive landscape, does that mean battery electric trucks? Does it mean hydrogen? And the answer is no to both of those for now and for the foreseeable future. If you're a large fleet operator in the UK today, and you have got decarbonisation challenges, and you need to decarbonize your long haul heavy truck fleet, you've essentially got two options. One is you run on HVO. HVO is a brilliant fuel. It's 100% sustainable and renewable biodiesel that you can run your truck on 100%. The problem with HVO is that it's expensive. So it's considerably more expensive than diesel. And people are struggling, or companies are struggling, to get long-term supplies. They can get to six month supply contract, maybe 12 months. And there's also the fact that a lot of the feedstocks used to produce HVO will also be used to produce sustainable aviation fuel in the future. So there are questions around the viability of supply. So then you're kind of left with biomethane. And there are two routes you can put biomethane into a vehicle. You can do it compressed, that we do, or you can do it liquefied through the bio LNG route. So if you then look at the overall competition in that space, in the public access CNG space, we today do not see any competition. I'm sure it will come in the future, but we're not aware of it today. If you look at the LNG space, that is a different model. That is typically, there are small handful of players in the UK that are offering those solutions, and those are on depot LNG private stations that can refuel 20, 30, 40 trucks. A very different model. Now we're seeing that is today a smaller market than the CNG market. CNG trucks on the road are probably 2x that of LNG trucks in the UK today, and we see that growth just continuing going forward. If you then look at the large energy players today, no, they're not really competing in this space. And then you might say, well, why not? Well, it's not big enough yet. We address 1%, a bit more 1% of the articulated truck market. Once we hit 5, 10%, that will change. How will they then get to compete in this space remains to be seen. But as you've hopefully understood from what I explained previously on how hard these stations are to locate and build, yeah, there are challenges there. So they'll need to find some other way of getting into the market. Okay. Do you use MRSs to test site potential for permanent stations? No, we don't really do that. MRSs are put in sites in locations where we know there will be strong demand from our existing customer base. They are there to pull forward volume for those locations and from key strategic customers who are on an adoption journey and just can't wait for us to get a station built. Because, as I said, building a station isn't just about the 8 months of building. It can be very complicated getting all the permits and so on and so forth. What is the competition? Is biomethane for HGV sold to motorway service stations? Okay, I've probably addressed most of that. Are there any other renewable CNG dedicated station operators? For public access CNG stations in the UK, the answer is no. There's none of those. And CNG is not offered at motorway service stations, and we don't expect it to be offered at motorway service stations anytime soon. Because if you remember the image of our Newton Aycliffe station, and you think that is essentially the footprint of a total motorway service area. So no, we do not see competition from that. And as of today, we are 100% of the public access CNG station market in the future, and we expect to remain that for the foreseeable future. Is the electricity price the largest variable for your profit margin, or does this pass through? Maybe Baden, that's one for you, please.
Yes. I guess the short answer would be yes. It depends really on the pressure tier of the station. As we saw very large electricity price increases in 2022 due to the Ukraine-Russia conflict and surrounding energy crisis. That had a larger impact at our lower pressure stations where we require more electricity to compress the gas. But at the higher pressure tier stations, really the amount of electricity we use is relatively low. So now that electricity prices have come back down, and particularly now that we've become a large electricity consumer, that the importance of electricity price has decreased substantially. Is the largest variable of our profit margin. It is our largest variable of our gross profit margin at some of the stations, and we do not pass that through. No, it forms part of the compression charge, but it is an increasingly smaller amount. And as we build and high grade most of our stations towards the intermediate and higher pressure tier networks, which is a luxury we, as I mentioned earlier, that we now have, the electricity price will become an increasingly less important factor, and is not dramatically impactful at the moment, as it is.
Thanks, Baden. All right, we've got one final question here. Any updates on competitors entering the CNG market? I think I've already addressed that one. How is LNG going? Also probably addressed that one. And then finally on hydrogen, so we announced last year that we're part of a consortium that has been awarded some funding from government to run a hydrogen trial. Yes, that is ongoing. That project is making progress. But as I say, that is R&D funding, and the bread and butter for this business, for ReFuels as a group, will remain biomethane for a very, very long time, based on the way we see the market today. But yes, we will continue to remain involved in anything that can decarbonize road transport and HGVs in particular. And as such, hydrogen, as I said, fast charging, and so on and so forth, we will be led by the market. If our customers want green hydrogen solution, we will offer that. If they want fast charging, we will find a way of offering that. But as of today, what they're requesting is biomethane, and we expect it to remain that way for the foreseeable future. And I think that was it.
Fantastic. Yes, Philip, Baden, thank you very much indeed for your presentation. Of course, any further questions come through, the company will have the ability to review those, and we've published responses on the Investor Meet Company platform where appropriate to do so. Just perhaps before redirecting investors provided their feedback, particularly important to you and the team, Philip, can I just ask you just for a few closing comments, please?
Thank you. Yes. First of all, thank you to all of you who've been tuning into this, and for those of you who'll be watching this on catch up later. Exciting times in the market for sure. That said, we're only getting started. It's taken us 10 years to get the company to where we are today, and given the growth ahead, some of the some of the exciting parts of the business as such, yeah, we're only in the early phase of really seeing and really scratching the surface of the market potential. We've got this funding process ongoing, which we'll update the market on in a bit when it is appropriate. But in general, yeah, lots of exciting stuff here ahead. And thank you once again for taking the time and showing an interest in us.
Fantastic. Philip Bowden, thank you indeed for updating investors today. Could I please ask investors not to close the session, as you'll be automatically redirected to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of REFUELS N.V, we'd like to thank you for attending today's presentation, and good morning to you all.